My time for the session is 35 to 40 minutes, but I want to give away 10 minutes of my session towards a team member because I feel he also deserves a chance to present himself. He will be nervous, so please excuse himself. But he will come on stage, he will speak for 10 minutes on valuations, and then I'll take over for the next 25 minutes. So please give a big round of applause for Samej Vardhaman. Yes, thank you. So first of all, I wanted to thank you, Naveen, for giving me this opportunity. Today, I am going to talk to you about the topic which is really close to my heart, which is importance of valuations. So myself, Samej Vardhaman, I joined Glory Bramwell 2 years back on the same date. So today I completed 2 years with Glory. I love to read books and I'm passionate about equity markets. So I'll start my session by Sir Charlie Munger's quote, who was the Vice President of Berkshire Hathaway and partner of Mr. Warren Buffett. He is a legendary investor. Charlie says, a lot of success in life and business come from knowing what you want to avoid. So it is important in life to know what are those things we need to avoid. Same thing applies into the equity investing. What are those things due to that we lose our money into the market? We simply need to avoid those things to create wealth in the equity market. So whenever we do investment, there are 3 pillars. First one is buying good company, buying at a good valuation, and holding those investment for next 10 year, 15 year or 20 years. Those are the 3 pillars of the investment. Opposite of that, whenever you lose money, there are few points like due to that we lose our money. First one is investing into the bad quality business. So if we compare the data of Sensex in 1992 versus 2024, out of 30 companies, there are hardly 3 to 4 companies succeeded. Reliance, HUL, ITC, those are the 3 companies. If companies are not going to survive for next 10 year, 20 year or 30 years down the line, as an investor, we will not create wealth. Second one is investing into the bad management. So there is a saying in Hindi, कोई धंधा खराब नहीं होता, धंधा करने वाले की नीयत खराब होती है. So Yes Bank, DHFL, those are the companies where promoter was not good. The honesty of the promoter was not there. Third one is buying a high debt company. Companies with lot of debt like CCD and Big Bazaar, those are the examples where promoters are exceptionally well, but due to high debt on their balance sheet, companies went bankrupt. And last one is ignoring the valuation and paying the high price. So today I am going to talk about that. So in our school and colleges, we all thought that high risk is equal to high return, low risk is equal to low return. But actually in investing world, it is completely opposite. The higher the risk you take, lower will be the return. The lower the risk you take, higher will be the return. People find stocks more risky when nobody is buying and the prices are low, and find it less risky when everybody is buying and the prices are high. I think we all want to buy things at a discount, whether it is grocery discount or clothes discount. But when it comes to investing, we try to run away from it. When equity market offers 20, 30, 40, 50% discount, we try to avoid investing into the equity. But we should, at those point of time, we should invest more and more amount. Now let us look at the valuations. What I buy is important, but what price I buy is extremely important. Said by Rakesh Jhunjhunwala. So now let us look at few case studies. First one is Infosys. Infosys employs more than 350,000 people in India. It is second largest IT company. Infosys went public into the year 1994 with the market cap of 50 crore rupees. 50 crore rupees. And current market cap is 7 lakh crore rupees. That means if you want to buy 100% stake of the company into the 1994, by just paying 50 crore rupees, you can buy entire stake of the Infosys. Let's assume that you invested into the Infosys. So during 1994 to 2000, from 1997 to 2000, there was a dot-com bubble where all company stock went up a lot. During that period, from 50 crore market cap to it became almost 58,000 crore market cap within next 6 years. It is almost 1,200 times return within 6 years. Let's assume that if you made investment into the year 2000 and you held that investment for next 10 years. Let's look what happened. This is the data, annual year's data. Number of employees from 5,000 to went 1,10,000, almost 20 times growth rate. Sales from 800 crore to 22,000 crore, almost 26 times growth rate in 10 years. Profit from 300 crore to almost 6,000 crore, almost 21 times growth rate. And the PE multiple of the company during the bubble, it was 200 times. That means if you want to buy 100% stake of the company, people are willing to pay 300 crore multiplied by 200 times. If someone wants to buy 100% stake of the company, they need to pay 200 times of their annual profit return. That means 58,000 crore market cap size. So assume करो 20 गुना कंपनी का नंबर ऑफ एम्प्लॉय काउंट बढ़ा है, 25 गुना सेल्स बढ़ा है और 20 गुना प्रॉफिट बढ़ा है. एनी गेसेस फ्रॉम द ऑडियंस? 10 सालों में कितना रिटर्न बना होगा इन्फोसिस में? कुछ गेस? कितने परसेंट, कितने टाइम्स? अगर 20 गुना अगर कंपनी का सेल्स और प्रॉफिट बढ़ा है तो? एनी गेसेस फ्रॉम द ऑडियंस? 10 times? 7-10 times. This is the reality. During 2000 to 2010, stock delivered just 6% CAGR return. That means less than FD rate. No matter how great company it is, if you buy at a wrong price, you will not create wealth. During same period, Sensex delivered almost 12.8% CAGR return for the next 10-year period. And Infosys just delivered 6% CAGR return. Next slide. I think HUL. We all use their products. Surf Excel, Reen, Ketchup, Pepsodent, Vim, Domex, Horlicks, Boost. I think 9 out of 10 Indian households use their at least one product in their house. Let's assume that you made investment into the HUL, largest company, succeeded for more than 40 years into the market. You made investment into 1999. Sales of the company went from 11,000 crore to 20,000 crore. Profit from 1,000 crore to 2,000 crore. And the starting multiple here again 46. And market cap to sales multiple is 4.5 times. So 12 सालों में कंपनी ने सिर्फ 2 गुना ग्रोथ किया. That means the CAGR of annual CAGR growth rate is just 6%. Any guesses? 2 गुना प्रॉफिट बढ़ा है तो कितना शेयर प्राइस बढ़ना चाहिए? कुछ भी गेस कर लो. Any guesses?
15-20 times.
15-20% return? Times. Okay. That is the reality. For next 12 years, people did not create wealth. The stock delivered just 2% CAGR for 12-year period. And Sensex during the same period delivered around 16% CAGR growth rate. This is the third example. Bosch, India's largest auto ancillary company. If you invested into the year 2015 and held that investment for next 10 years, sales went almost 2 times, profit went almost 2 times, and the starting PE multiple again here 77. Market cap was 8.5 times. Returns again delivered 0 return. Stock price during 2015 was 26,600 and current stock price is 26,500. Delivered 0 return. During same period, Sensex delivered almost 10% CAGR return. No matter how great company it is, if you buy at a wrong price, you will not create wealth. That is the mantra. Price is what you pay and value is what you get. You have to make sure you are buying 100 rupees worth of asset at a 50 rupees. There has to be margin of safety when you make investment. And thank you.